Last month, we had a Landaas Company family picnic at our house. We had about 90 adults, children. We had face painters for the children, balloon twisters, a magician. Just for fun, we threw in a flame eater, fire eater. Not sure that was the right image for the children. We even dragged out the karaoke machine as the evening wore on. But perhaps one of my favorite parts of the day was when 10-year-old Brooklyn Becker came up and said, "Mr. Landaas, I made something for you." So this is going to be a little difficult for those of you in the back, so let me explain. What you're looking at is fluorescent large popsicle sticks, okay? And on the front, it says earnings and interest rates. So 10-year-old Brooklyn Becker gets it. She's the daughter of a senior executive at the company. This is one of my favorite gifts of the summer. The relationship between earnings and interest rates has never been more important than right today. We've had economic expansion for over 8 years, and the most challenging economic question is, why is inflation so low after 8 years of growth? So we're going to go a little deep this morning on the relationship between earnings and interest rates, why it really matters right now for the markets, and give folks a sense of which way we think the winds are going to be blowing. You know, the best thing I can say about the economy right now is what's called synchronized global growth. Doesn't happen that often. What we're talking about here is every developed country in the world is growing at the same time. Hardly ever happens. Happened 10 years ago for a little bit. Happened in the late 80s. Before that, happened in the early 70s. So as you can see, just 4 times it's happened since the early 70s. So what we're looking at is slow but broadly based economic growth. You sell caterpillars overseas, you need your customers overseas to have more money in their pockets to be able to buy your product. I'll be talking a little bit later about the decline of the US dollar. So not only do the customers overseas have more money in their pockets to buy what we're selling them, but our products became less expensive because of the decline in the dollar. This summer kind of led the list with questions that I got from many of you about geopolitical risk worldwide. Most of you have read about the pressures that North Korea has brought to the table amongst a host of other issues. And I want to just nip this one right in the bud here and tell you that Brooklyn Becker gets it, earnings and interest rates. Geopolitical risk tends to be short-term. In business school, they taught me that picture a pail of water, put your hand in the water, you can splash around all you want, that's the geopolitical risk. But eventually you're going to pull your hand out of the water and the water is going to go back to equilibrium. So statistically, you look over time, geopolitical risk can matter short term, but ultimately what drives the markets is earnings from corporations and the level of interest rates, and more interestingly, the relationship between earnings and interest rates. So we have moderate to modest growth here in the United States. GDP should come in above 2% for all of this year. Most of you know that we had 3% GDP this last quarter, a pretty good number. Economic growth has not been above 3% for the last 12 years. So we've known for years that recoveries from financial crises tend to be weak, tend to take a long time. This one wasn't any exception, was weak, and it took a long time. It's important to point out that this is the 9th year of our current business expansion. Here's a little bit of bad news. In U.S. history, we've never had a business expansion that's gone past 10 years. Doesn't mean we can't, doesn't mean we won't. It just has never happened in our nation's history. It's interesting to look at what drives growth, or as we call it, GDP, the broadest measure of goods and services produced here in the United States. And it's easy to explain. That's why I have this chart out. There's only 2 things that drive economic growth. Number one, growth in workers. And number two, what we call productivity growth or output per man hour worked. Right? How many pens can you produce in an hour is the analogy that I'm fond of. So if you look at to the far left, right, GDP for the 10-year period from 1957 to 1966 grew at 4.2% a year. It's a lot. Look what drove it. 2.8% increase every year in the growth of workers. You know why? It's because women entered the workforce in droves. Right, so we had a big increase in the labor force, and that drove GDP for 10 solid years, 4.2%. In the green down at the bottom, that's productivity, output per man hour worked. Now I'm going to jump right to the punchline. Women are having fewer kids. In the United States, the average woman now has 1.7 kids. Because of infant mortality, you need 2.1 just to stay up with population. So the population, the working age people entering the workforce continues to decline. You can see just from 97 to 06, 3.2% GDP, 1.9% increase per year in the labor force, due mostly to the kids of boomers jumping into the workforce. Right? So the last 10 years, you can see that the labor force only grew 0.9% a year. Now that's all easier to explain than the next point. Output per man hour worked. That one's got the economists puzzled. Right? Now there are various explanations. Personally, I like Janet Yellen's explanation last spring. And she said, refreshingly, perhaps it's just the lack of good ideas. But we knew in the 90s, the introduction of fax machines and cell phones, a host of other wonderful technology that had made many of us quicker at our jobs. So productivity jumped, but now it's as flat as a pancake, and the economists can't explain it. So these are the underpinnings of GDP, pretty easy to explain, population growth and productivity growth. Economists will tell you that productivity growth is the only way to increase aggregate net worth, the only way. So having said all that, you look at household formations in the United States, many parents are going like this, and the kids are finally moving out of the house because they're finding jobs, they're partnering up, the marriage rate is on the increase, household formations are on the increase, and that's all good news for the economy. U.S. consumer confidence rose in August, as I show on the chart, to the highest level in 17 years. Folks, that's a big deal. We have 180,000 new jobs created on average per month for the last 12 months. That's a very high number for this late in the cycle. We just finished 7 years of job growth. That's the longest stretch in U.S. history for job creation. So no wonder why consumers are feeling good and spending is doing okay. So a sign that consumers are feeling generally upbeat about the economy, of course, translates into the higher consumer confidence. Confidence numbers are two questions. How do you feel today? How do you think you're going to feel in 6 months? And the numbers are fairly strong. So not only are consumers feeling pretty good about themselves right now, but so is corporate America. Corporations are enjoying solid balance sheets, earnings, and margins. Margins are just a tad below their all-time high that got set 2 years ago. So guys like me tend to obsess about inflation halfway through a business cycle. I keep looking over my shoulders, waiting for something to move in for the kill. Most recessions since the end of the Second World War have been caused by higher inflation. The Fed raises interest rates to discourage economic activity, and they finally beat inflation down, but they tend to put economies into recession. The current low level of inflation contradicts prevailing economic theory and is one of the most challenging issues for the economy and the financial markets today. Some of you may remember from college that the British economist A.W. Phillips, 60 years ago, coined the term the Phillips Curve. It's been economic gospel in the United States ever since. Now, to be fair to Professor Phillips, when he first started the study, he would compare the unemployment rate to wages. Now, since then, the use of the Phillips curve has morphed into something a little bit more general, where they look at the unemployment rate against the level of inflation. So, in the mid-90s, Alan Greenspan talked about the economic miracle when unemployment fell below 5% in 1995, and yet inflation didn't take off for 3 more years. So you can see graphically what the Phillips curve looks like. On the left-hand side is inflation, bottom is unemployment, and simply explain when inflation is up, it typically is because unemployment is low. You take a look at this chart, the orange is the unemployment rate, the blue is wage growth. So let's start with the spike, you'll see in the early 80s. We had 2 back-to-back recessions, 1980, 81, 82. Hit Milwaukee pretty hard. At that time, we led the nation in jobs and manufacturing. So if you look at the spike in the unemployment rate, and you see how wages plunged, right? And there's a pretty good parallel going into the 90s. You look at 94, 95, unemployment rate peaked, wages were down. But look at the far right of this chart. So the unemployment rate has gone down every year for the last 8.5 years, and wages are flat as a pancake. So why is that? Doesn't normally work that way. Fed policy for decades in this country has been price stability. Look at what the Fed's been doing the last 1.5 years. They've had a 2% inflation target. They can't even get close. So many had incorrectly forecasted inflation would rise with government bailouts, quantitative easing, and historically low interest rates. A number of you are going to remember that for years now, I've said, what if interest rates come down and stay down? It's not what most of you have read in the popular press. You've been overwhelmed with articles for years and years that said eventually interest rates are going to take off and bonds are going to get shellacked. It's fascinating to me as a manager that that's the most asked question I get at the firm. And never mind that the risks in the bond market are teeny compared to the risks in the stock market. But that's the question that I get hour after hour, day after day. Bob, I keep reading that bonds are going to get creamed because interest rates are going to take off. And all those analysts were wrong. It's never happened. So if you look at this next chart, the personal consumption expenditure index, buried inside the GDP report that comes out every 90 days. That, of course, is the Federal Reserve's favorite measure of inflation. Take a look at the red line, 3.3% inflation since 1960. That's the average. But many of us are starting to think that the inflation that we saw in the 70s into the 80s was more an outlier. And the norm is something quite below the long-term average. So take a look at inflation since the mid-90s. It's gone down and stayed down, right? So after 8 years, think about this as an example. Household debt recently passed the levels that we set in early 2007. So why isn't the 10-year Treasury above 4%? It's barely at 2% right now. So not to belabor this, but inflation is down, and it potentially could stay down for a while. So of course the question to ask is, why is inflation low? For many of you that listen to the podcast, Brian and I, Kyle, and others have been talking for quite some time about the majority of new jobs being created are in food service and healthcare that don't pay. And frankly, that overly simplifies what truly is the issue. Starting in the financial crisis, corporate America went on profound cost-cutting campaigns. And it exists to this day. But beyond that, we have companies like Amazon. Talk to anybody that competes with Amazon, they'll tell you it's pretty tough. It's all about price these days. So Amazon's helping to push down retail prices. Uber, I use it. Great way to get around. It's hammering transportation costs. I told the story last year about these two girls come to our house in River Hills in a beat-up Camry. My wife had ordered some books from Amazon Prime. They showed up on our doorstep that afternoon, right? So Amazon's using Uber-type delivery services to get my wife her books. Same day service, right? Look at Airbnb and what it's doing to hotel prices. Seems like half of America is becoming a hoteler, right? Renting rooms out, competing with hotels. A lot of people I know don't ever go to hotels anymore. Why do that when you get a nice 3-bedroom house in a quiet neighborhood? Artificial intelligence, talk to anybody in manufacturing, the use of robotics. Vast majority of manufacturing jobs that have been lost last 10 years, they didn't get outsourced. They went to the robots. Contract workers, what we call the gig economy, right? The use of labor where I'll hire you for 9 months, not going to match a 401k, not going to pay you health insurance, not going to pay you any pennies. At the end of the 9 months, hey, we'll see you later. We don't use gig workers at our firm. That's just an example. But contract workers is exploding and, in fact, is the new normal. Here's one that bothers me. I had a conversation with a client a couple weeks ago, senior executive, IBM, 55 years old. They're going to let go of him. You know why? They can hire 3 people to do his job for less money than they pay my friend John. I used to think that stuff was illegal, but companies are getting away with it left and right, let alone the boomers retiring and being replaced with younger, less experienced workers. So all this stuff has served to keep a lid on inflation. Okay, so the follow-up question is, Bob, why do I care about this? Why does this matter? And again, I'm going to go back to Brooklyn Becker, earnings and interest rates. So somebody can take $1 out of their purse and on average get 5.6 cents of earnings off the average stock. So folks, what we're talking about is just the reciprocal of a price-earnings ratio. Take a PE, turn it on its head, and you've got an earning yield calculation. You can take $1 out of your wallet and get a little over 2 cents of interest on the 10-year Treasury. Here's the part that we ought to agree upon before I go further. 5.6 is a bigger number than 2.1, right? Now, the 2.1 is a sure bet you won't get hurt. The 5.6% is a maybe and a probably, and a I hope so, and your money's going to go like this. So the current gap helps to explain why stock prices are going up, and it serves as fundamental support to the stock market. So the challenge, of course, is in figuring out where earnings are going, and as importantly, where interest rates are going, back to the point of inflation. If inflation stays low, interest rates stay low, which supports higher stock prices. Now here's the bad side of the story. We've known historically that with unemployment at 4.4%, not happening now, but in the past, inflation tends to percolate, right? So what if, just what if, the 10-year were to go to over 4% and earnings came down a tad, right? That's where you run into some struggle, right? Because most of us are going to say, you know what, I'm getting barely 5 cents in earnings off the average stock. I can get over 4% on a sure bet. I'm going to give up that 1% and head for higher ground. So if bond yields go higher, higher inflation, or earnings yield goes down because of lower profits, the fundamental dynamics of the markets change. So it's just really important, everyone, that we follow the earnings yield versus the bond yield and look at the spreads. So this chart gives you a sense of how high historically the spreads are right now. The dotted line is earnings for the S&P stock composite index. The solid line is the yield on the 10-year treasury. So here's the short version of all this. The spreads are pretty high right now. You want to pay attention to it. When the spreads start narrowing, then the markets tend to run into difficulty. Look at the period right before 2000. There's a heads up that the 10-year treasury yield was higher than the earnings yield, and there was no way that it could support higher stock prices. So the conundrum of continued low inflation at a time of low unemployment creates one key outcome for investors. Interest rates remain historically low. We had the privilege of doing a conference call a week ago Monday with this big shot in Boston. Charles Melcrete manages billions and billions of dollars for a major fund family. We had 31 of us around the conference table at work, had this guy on speakerphone in Boston, and he shared a story with us about a pricing survey done at MIT just down the street from him. The problem with the Commerce Department consumer price numbers is by the time the numbers actually get released, they're pretty stale, right? So MIT started a study where they're following online purchases, right? And they can transmit the data instantly. So they've got a really current online sense of where prices are going in the United States. Now here's why I bring this study up. What Charles Melcrete told us that the MIT survey is still showing that inflation is coming down, but it appears to be forming a bottoming formation, right? Which means it ain't going to go down forever. And the conundrum that we all have is, all right, inflation may not be going down anymore, but is it going to go up in a meaningful way to change the markets? So low inflation may be fading, but that's very different than inflation about to reaccelerate on us. Long term, I'm pretty confident that interest rates are going to stay low for a lot longer than what most people realize. I'm going to shift over and talk about the US dollar here for a minute. This one confounded a lot of folks. Dollar had been strengthening for over 4.5 years. Most forecasts for this year called for yet a stronger dollar. Now all of a sudden, overseas economies, because what I described initially as synchronized global growth is accelerating. So the dollar's now fallen to its lowest level in 2 years, down a little over 11% since the beginning of the year. Go back to my Caterpillar example. The guys selling earth moving equipment overseas not only are selling to customers that have more money in their pocket, but their product is less expensive because the dollar has gone down. Dollar's weakened in many cases because the overseas countries are doing a little bit better than we are, so their currencies are strengthening and ours are weakening. Most of you know this top bullet point. We're in the second longest bull market in U.S. history. There are no signs of recession at this point in time or a spike of inflation, which suggests the bull market is not over. I read a not too pleasing analogy the other day that recessions are like carbon monoxide. They kind of sneak up on you without you realizing it. Nobody ever rings a bell and says, ding, the recession started. So there are a couple of things that we can look at to get a hint of which way the winds are going to be blowing. You look at the stock market, I don't get to tell you anymore that stocks are cheap. They're not. I was able to tell you that 4 or 5 years ago. Stocks are a little on the expensive side. There's 3 ways to look at earnings. My favorite is the middle one. But trailing PEs looks at the last 12 months earnings for the S&P. Market's currently at 21 times 12-month trailing earnings, almost 22. Got a chart coming up here that'll show you the comparison to averages. Forward PEs is my favorite because I don't care about what's been, I care about what's gonna come. Forward PEs only go out 12 months, so when earnings are about to do this, you just arbitrarily chop off the 12-month period, so you're not getting a better look into past 12 months on a forward PE. And then the CAPE ratios never got traction, but for some reason the media likes to talk about them. Professor Schiller from Yale dragged this one out. Looks at cyclically adjusted price earnings. That's what CAPE stands for. And Schiller just chose arbitrarily 10 years. Well, the problem with a CAPE ratio that goes back 10 years is that it takes into account the financial crisis where, forget PEs, companies didn't have earnings for a while. So the PEs got skewed, and I'm not sure that the CAPE ratio matters. So back to forward PEs. 3 years ago, the forward PE on the market was 16.2, which means that a lot of good news is currently priced into the market with a forward PE of just under 18. Just as I said that we're now in the 9th year of this business expansion, and we've never had one in the nation's history that's gone past 10 years, I want to look at bull markets. Right, so the longest bull market in U.S. history was over in March of 2000, lasted 113 months, long time. Great time to be in the investment business. The current cycle on the far right is the second longest bull market, 101 months. And as I've always said, markets don't die of old age. They die of a deterioration in the fundamentals. In English, meaning interest rates take off or earnings go down. So it's important for folks to know that, yeah, stocks are a little expensive. Yeah, we're in the latter innings of this ball game. But that doesn't mean that the party has to end anytime soon. So here's the stock I referenced just a minute ago. You can see on the left side, we're talking about trailing earnings. So the current is 21.7, average is 16.2. You can pick any time frame you want. We picked going back to 04. Forward PEs, just under 18, average is 15.7, again going back to 04. So a little bit above average. As much as we talk about earnings driving stock prices, it's not a nice and tidy increase or decrease every year. Consider that last year, earnings didn't go up on average because of the collapse in oil stocks. But the market did okay. So this year, earnings are supposed to go up 11%. You look into next year, so we're about to get past the confessional season, which means that you don't wait till the end of the year to tell your boss you're not going to hit your numbers, right? Stocks get pummeled when that happens. So the news tends to leak out after Labor Day, and companies start confessing, that's why they call it the confessional season, that, hey, we're not going to hit our numbers, or you know what, we're going to go way past our numbers. So the numbers are kind of baked into the cake for this year. So people like us tend to look ahead 6 to 8 months or more. Earnings are supposed to go up 10.9% next year. And then take a look at the year after. Pretty nice increase, 9%. The street comes anywhere close to these numbers, we should do okay. But a lot of this has been factored into the market. So earnings are looking pretty good here the next couple of years. As I mentioned, as a short-term measure, high valuations have almost no predictive value. And I put this next point in, not to be a wise guy, but just to state the obvious. Bear markets don't start when PEs are low, right? They start when valuations are high. It's important to keep that in mind. You look at the stocks that are doing really well right now, it's the growth stocks. Multinationals, because of the decline in the US dollar, growth stocks and international stocks are leading the list. Small caps led the markets after the election because they were widely viewed as standing the most to gain from deregulation and a change in the tax code. And because of the delays that we've experienced in seeing anything come from Washington, the small caps have totally faded. Some of them are negative for the year. So all the stocks that had a big bump after the election have all faded, and in their place, it's been the growth stocks and the multinationals. If you look at the bottom bullet point, this says it all. The 50 stocks in the S&P with the most overseas revenues were up 13.8% for the first 6 months of this year, compared to the 50 stocks with the most domestic sales, meaning mostly small caps, are up only 1.3% for the first 6 months. Huge gap, huge dispersion in the markets. Frustration for active managers the last handful of years has been what we all call risk on, risk off trade. So people jumping in and out of the market, not discriminating with individual securities, but buying the market overall through the use of index funds. So fortunately for active management, you're seeing correlations dropping right now. And what I'm saying is there's a huge gap now between growth stocks and value stocks, let alone large caps compared to small stocks. The dispersion between value and growth is at historically high levels. Consider that growth stocks have outperformed value stocks by more than 3 percentage points for the past 10 years. So that's a lot. Year-to-date returns, growth stocks, according to the Russell 1000, up 19.2%. Russell 1000 value only up 4.8. This will drive the point home. So folks, what you're looking at are the 9 style boxes according to Morningstar. Take a look at the right-hand side, that's where growth stocks live. Large cap growth up 19.2% through the end of August, compared to large value up only 4.8. That's a huge spread. Then take a look at small cap value. They've just been crushed in this market, and year to date are actually showing a negative return. I like showing this next chart because it gives you a sense of history. And what you're looking at is current PEs for the 9 styles as a percentage of their 20-year average. Right? So here's the takeaway point. On a relative basis and an absolute basis, stocks aren't cheap. You look at growth stocks, this is an interesting one. Growth stocks are trading at 124% of their 20-year PE. That's high. Now, some of you with good memories will recall 5-6 years ago when we put that chart out, that growth stocks were selling for 80-85% of their long-term 20-year PEs. So growth stocks are getting caught up more than that. And as attracted as I am to value on a relative basis, yeah, fine, it's cheaper than growth, but on an absolute basis, it's not. So in the old days, I used to give entire speeches based on the fable of the tortoise versus the hare. New people would come into my office and want me to bet on some fast rabbit, and I'd roll out that story of wait, the turtle won the race. And look at the far right of this chart. So for the last 20 years, values made more than growth. The last 30 years, values made more than growth. The coolest part of that story is that value is the most conservative end of the market. That's the coolest part of that. So you don't need to take lots of risk longer term to do well. You just need to stay in the game. But the market is getting distorted now when you have an economy barely growing at 2%. Investors, you can't blame them, are migrating to the companies that show growth of earnings. So look at how far it's changed year to date. Growth 19, value 4.8, as I mentioned, trailing 12 months, same kind of thing. So it's not necessarily a message that we all need to pour into value, but at some point in time, we're going to need to lighten up on growth. Growth stocks sink like rocks when the markets go down. So we talk about breadth of the market. What that means is you want to see a lot of participants. Okay? 5 stocks, Facebook, Apple, Amazon, Microsoft, and Alphabet, the parent of Google, 5 stocks, account for 40% of all the gain in the markets this year. Facebook, Apple, Amazon, Microsoft, and Google, 5 stocks. So we're starting to see the breadth of the market narrow. Not a great sign. I've not been particularly fond over my 40, almost 3 years of doing this, of technical analysis. But I do want to point this out, that the percentage of stocks that are trading above their 200-day moving average just fell below 50%. Okay? That's happened 24 times since 1996. In 23 times, the S&P 500 fell just below its 200-day moving average, which would take the market down about 6%. So corrections like that don't particularly worry me. What worries me is when a recession is on the horizon. That's bad for stocks. But signs of a major market top are not apparent. We don't see indications that inflation's about to take off. We don't see any indications that interest rates are about to take off. Earnings look pretty good for the next couple of years. But I think basic common sense says that caution is in order. Here's a good story. You look at global equity valuations, we don't get to tell you anymore that values are below average overseas, but we still get to tell you that they're more attractive than here in America. If you look at the top line, US, current PE, these are forwards, just under 18 as I keep bringing up. 15-year average, I showed you 13 years. The 15-year average is 14.9. Dividend yields, they haven't changed any last 15 years. EFA, so that's Europe, trading at 14.9 forward earnings. Their average is 13.3. Good news in Europe is their unemployment rate is 9.1%. They've got room for improvement compared to the U.S. at 4.4. We're not going to create many more jobs. The emerging markets, they're attractive. 12.4 is their forward PE, average is 11. Dividend yields look pretty tasty to me over in Europe. In the emerging world, they're quite a bit higher than what we're seeing in the United States. Now, for a number of years, I would talk about a study that came out of the World Bank that estimated that the middle-class population in the world was going to triple by 2030. Triple. It's a lot. None of the growth was going to come from the United States, Europe, or Japan. It's all coming from Asia and to a small extent, Latin America. Right? So here's a chart that kind of tells you something a little bit different, same punchline. Look at the Asia Pacific column. You're trying to look at the forecast in middle class consumption, buying. It's supposed to go up 558%. So folks, that's a big number. This is an interesting chart because it looks at the developed markets since the beginning of 13 compared to the emerging markets. China is not the drag on emerging markets as earlier thought. But take a look at the developed world, up 56% since the beginning of 13. Emerging stocks are only up 6.8% since the beginning of 13. And a lot of that had to do with China. You know, if you're in Brazil digging iron ore out of the ground, you're sticking it on a barge, sending it over to China. So for a while, China wasn't calling you as much. So whether you're digging iron ore out of the ground or copper, China wasn't buying as much. And now they're not the drag that they were on the emerging world, which in our opinion creates opportunities. I just want to distinguish between overseas markets and the developed world compared to the emerging markets. Emerging markets are not for the timid, they're not for the weak, they're not particularly appropriate for older retirees, but for long ball hitters, it represents, I think, an opportunity. Now back to the question that I get all the time at the office, interest rates. Bob, I keep hearing that interest rates are going to take off. I keep hearing that because of the end of quantitative easing, because central banks are less accommodative around the world, and on, inflation is going to take off. So it's important to distinguish between the Federal Reserve aggressively raising interest rates because of inflation compared to resetting monetary policy back to neutral. Very different outcomes. So as I mentioned earlier, guys like me obsess about inflation halfway through a cycle because that's normally how the party ends, right? But this time around, because of hardly any inflation and very low interest rates, yeah, the Fed is raising the short-term rate, but it's just a reset monetary policy back to a neutral position. It's interesting that they keep moving the goalposts. Right, a couple of years ago, the Fed was indicating, and analysts thought that the overnight rate would head to almost 4. Nobody thinks that anymore. They think the goal may be more like 2.5%. So very different outcomes. I'm not all that worried about the Fed resetting monetary policy back to neutral, but let me tell you, I'd be really worried if inflation took off and they really had to ratchet up the overnight rate. Monetary policy is shifting now to balance sheet reduction, away from the monetary policy of the Federal Reserve changing interest rates. The Fed is expected to slowly start unwinding its bond portfolio. The Fed's balance sheet quadrupled to $4.5 trillion. Got some clients from Illinois, and I'm reminded of Everett Dirksen's comment. This was when I was in college, well-known senator from Illinois. Billion here, billion there, pretty soon you're talking about some serious money. So we're talking trillions, right? Swelled it from under $1 trillion to $4.5 trillion to get the country back on its feet. So the purchase of treasuries and mortgage-backed securities, that they're done buying and they have to start unwinding it. And the Fed's announced that they're only going to do 30 billion, they think, to start a month, which is a drop in the bucket to $4.5 trillion. So most experts, as I mentioned on the slide, think the process will be slow and it'll have fairly little impact on the financial markets. Our best estimates is the 10-year is probably going to climb a little bit before now, and at the end of the year, we may see the 10-year at 2.3, maybe even 2.4. End of next year, 2.8, maybe 2.9, heading towards 3, and that'll be it. The biggest worry that we have in the bond market is declining credit quality that could be an issue next year and the year after next. Spreads between high yields and treasuries are now at about 400 basis points, 4%, which is good news. When spreads are very high, pretty much adds up that trouble's ahead. We saw that a couple of years ago when the oil companies got pummeled. Over a third of junk bond issuance since the downturn went to the oil industry, and they had a hard time paying back for a while. But most of those troubles are behind them in the oil patch, so the spreads are a little bit below average, and that's actually an encouraging indicator. The hurricanes, along with low inflation, make it less likely that the Fed is going to raise in December. Instead of raising the overnight rate, they're going to start unwinding their balance sheet. So monetary policy is shifting in a way that I don't think is going to be harmful. Forecasts call for 2 to 3 rate increases for each of the next 2 years, which, as I mentioned, would bring the overnight rate to give or take somewhere in the high 2s. Now here's something that I found fascinating. The Fed's raised rates 3 times since last December. So if you look at an X and a Y axis, interest rates over time, here's the short-term rate, here are the intermediate rates. The Fed raised rates 3 times since last December. The short end came up, but the intermediate end came down. Contradicts what most people think about the bond market, right? So you saw the yield curve flattening. A flatter yield curve is very predictive. Tells us all 2 things. Number one, that growth is only going to be moderate to modest moving forward, and the street's not the least bit afraid of inflation. So short-term rates have come up, but the intermediate yields have come down. Most of you, me included, are thrilled with the performance of our bonds this year. You look at the middle line, that green line shows you the yield curve. And to understand this point, look at the far left. You can see the green line just above 1%. That's the overnight rate. The target is currently between 1 and 1.25. And yet the intermediate and long-term bond yields fell. This guy, Charles Melcrete, that I mentioned before from Boston, a year ago, October, this guy on a phone conference told us he just spent $140 million on a 30-year treasury. Our jaws dropped when the guy told us that. That's a gutsy call. He made a killing off that bond as the long end came down in spite of the Fed raising the short rate. So the Fed only controls short rates. Most of us know that. The street controls everything else. So if the outlook for inflation is coming down, it allows the intermediate bonds to react favorably. Now here's the heads up I want to give you. When the yield curve inverts, which simply means that the overnight rate is higher than the 10-year treasury, it's not good news. All right, historically, it's amongst the most accurate indicators of a coming recession. The yield curve inverted before the last 7 recessions. So that's not just some of the time or most of the time. It happened every time prior to the last 7 recessions. So trust me, folks, I pay a lot of attention to the yield curve. Now, of course, it wouldn't be a seminar unless I dragged this one out. I'm proud of the fact that I've spent over 40 years talking about humility to my staff, my clients. Pretty tough to call the future. What we can tell you from an academic standpoint is that when you study risk and reward, that if you get a whole lot past 60% in stock, you guys all know this, your risk line keeps going up, but your return line tends to flatten out. Right? Look at the lower right-hand part of this chart. Might be tough to see on the screen. You probably can see it in your printouts. But look at the return, 60% in stock, 40% in bonds. And we're going back 30 years. We never changed the time frame, folks. Every time I put this chart out, it's the last 30 years. So 60% in stocks, 40% in bonds. You can see the return is 9.2%, right? Then drop to the lower right. Had you been all in, I don't know who's crazy enough to do that, but had you been all in, you only would have made 0.8% more, right, for 60% more risk, right? Look at your standard deviation going from 10 to 16, almost 17. So we try to be really stingy when we take risk. Risk is good, but risk can be bad. I want to get paid for the risk I take. And if not, I don't want to take the risk. So we try to figure out what's the right level of risk for all of you to take. Now, because we're not a wirehouse and we don't underwrite securities, we don't always have to be bullish. And because we don't make a market in securities, we get to call it the way we think it should be called. So this is the academic underpinnings of the balance. And yeah, there are times when we want to lighten up. There are going to be times we're going to jump on the gas pedal. Everybody gets a customized portfolio at our company, because we like to think that every one of you are different and have a different story to tell. But what I want to do, before I turn the program over to Brian, is to look at this slide for bear markets and recoveries from bear markets, because this is the essence of balance, in my opinion. So if you look at the middle of the chart, what we're talking about is how long does it take markets to recover from the peak to the trough back to the prior peak. The Arabs stuck it to us, quadrupled the price of oil, then doubled it again the next year, created the worst recession at the time since the Great Depression in the 70s. Stocks got whacked. Took 5 years and 8 months for stocks to recover. Basically, it took until the 80s, okay? 5 years, 8 months. Financial crisis, you look at the far right, took the average person a little over 4 years to get your money back. So one of the better things about a 60-40 mix, in my opinion, is that if you limit your withdrawals to 4%, you have 10 years of withdrawals sitting in bonds. So no ifs, ands, doubts, or buts, you got your bases covered. And you go back here over time, right? You see just the average from the peak to the trough back to the prior peak is just a little less than 2 years. So if you look at the two longest recoveries, 5 years, 8 months, followed by what happened in the early 2000s, right? You got your money back there a little less than 3 years. Let alone the financial crisis. Hopefully we'll never go through another one of those. But yeah, fair enough, that took a little over 4 years. So I've always thought it's really smart as a practitioner to, number one, to practice what the academic studies show. And number two, be really stingy about the level of risk that I take. I want to get paid for the risk. If I'm not being paid for the risk, I'm not going to take it. And finally, to this point, to make sure I have enough money nice and safe to fund withdrawals on average for 10 years or more. You know, some of you that I work for feel a little bit more comfortable taking more risk, and you're happy with 7, 8 years of withdrawals sitting in bonds. Well, some of you have enough money already in bonds to last you the rest of your life, and you're growing the rest of your wealth for the next couple of generations. So everybody's a little bit different. Some people take out a little bit more than 4%. Some people take out a little bit less. So we try to customize this, but this is the essence of understanding balance, making sure you have enough money in safe bonds to tide you over well past the normal period of time that it takes stocks to recover. I certainly appreciate everybody's attendance this morning. Such a beautiful day. Thank you.